Hi guys, it's Jonas here. And with the crazy stock market roller coaster in this pandemic, we're going to ask the question, when will we hit the stock market bottom? And because on this channel, we are always about what it means for you, when is the best time to buy stocks? Stay tuned for my answer, as well as the top 3 things to do already today to make sure you buy at the right time. Those 3 things are, don't put off purchasing index funds, save consistently out of every paycheck, and third, save an emergency fund before investing. As a bonus, if you stay to the end, I will share how I time my own stock market purchases. Let's jump right in. While investors are in some rough waters in 2020, I think it's important to point out that we had a strange year of investing in 2019. The returns of the S&P 500 were just short of 30% for the year, which is 3 times the expected returns based on the performance of the same index over the previous 90 years. There's even the danger that we become accustomed to that level of returns and don't know what to do when the markets get rough. So what is going on now? With the effects of corona lockdowns on our economy, the market has taken a tumble, down over 20% from the beginning of the year. So historically, how bad is this 20% drop? If the market doesn't recover from current levels by the end of the year, we would be in the same boat as we were in the financial crisis of 2008, the dot-com bubble of 2002, the oil shocks aftermath of 1974, and the Great Depression years of 1930, 31, and 1937. So will the stock market recover by the end of the year? The answer is nobody knows. Anyone claiming they know the timing of a pricing event is not to be believed. If you are an excitable person like me, it can be easy to get swept up with where markets are today and where they're headed. I believe I talk for many when I admit that often at the back of my mind, I wonder when and how I might buy into the market at just the right moment, the bottom of the market, and make a much better return than I otherwise would have. This thought is perfectly natural and understandable, as it's analogous to the question, why work harder when you could work smarter? The problem with following this line of reasoning is that we are more likely to cause ourselves more harm than good. For every dollar we put off saving and investing, we are losing all chances of growing both our principal and interest for that investment. Millennials as a group are saving money regularly, which is great and 1 or 2 steps ahead of some earlier generations. But an issue that millennials and Generation Z often have is a reluctance to then go ahead and invest those savings. There are many reasons to put off investing, and many are very good reasons. For example, paying down debt, student loans, car loans, or loans from family, buying a house, saving for a down payment, planning a house upgrade to accommodate a growing family. Third, not knowing enough to get started, having some ideas but not being sure who to trust. Worries about losing money. Is an investment safe enough? Will I regret this move? And lastly, there's of course putting off decisions about what to do with those savings and when to invest. These are all very valid reasons not to invest. And if you have savings but are struggling with one or more of these issues in building your investment habits, you are actually in a great place. The vast majority of people today still don't save and invest on a monthly basis. And dealing with these issues, which are putting off your investing, is a sign you're on the right track. You just need that extra little nudge to get the ball rolling. Regardless of your reason, waiting to invest is perhaps the most expensive mistake you can make. So say you're ready to get rich with your investments. I have good news and bad news for you. The sobering truth is that investments won't make you rich. The good news is that investing a lot of money can. So wait, investments won't make me rich, but investing can make me rich? That seems like a pretty clear contradiction. Let me explain. If you invested $100 and attained the 10% annualized return of the S&P 500 for the next 30 years, compound interest would grow that amount to about $2,000. If you chose the ultimate long-term investment and achieved Warren Buffett's golden year returns of 17% annual returns, that $100 would have grown to over $15,000 over those same 30 years. While those are great returns, for having invested only $100, a few $1,000s does not yet make a person wealthy. However, had you invested $100 every month for 30 years at even the market return of 10%, you would have over $225,000 at the end of that period. The point is that what matters most in building wealth is investing actual money. Investing isn't magic. Investments don't create wealth from nothing. Investing creates a little more wealth from a little less wealth, something more from something less. The more you put in, the more you get out. While this might seem obvious, the aura of investing and the world of Wall Street often revolves around the mystique of creating money from seemingly nothing. The reality, though, is that what matters most for your investing outcomes is how much you put into the market in the first place. Okay, but let's just say, for the sake of argument, that you know exactly the right moment to invest. Let's say of all the oracles out there, you found the one who knows the date. She knows the exact date, the bottom of the market. Yeah, I already established that's impossible. But if you had that information, wouldn't the way to benefit from this be to go all in and spend all of my money on index funds on that day? Well, probably not. The last step to take advantage of the bottom of the market is to make sure that you can buy. While simple in principle, the issue of having actual money in cash is no walk in the park. It requires sacrifice. If your life outside of the stock market changes and you run into financial trouble in your everyday life just after you've made the buy of your investment career, how can you respond? If you need the cash today for something more important than your finances, like the health of yourself or a loved one, you may be forced to turn around and sell those assets for a loss after fees, even after having timed the market perfectly. The answer to this issue is quite straightforward, but it requires taking a responsible rather than simply a market return-oriented approach. By defining your risk and setting aside the appropriate cash reserves before you invest in your future, you can take one step forward without having to take 2 steps backward as a result. The other reason why not to put everything in then is that in real life, we still need real cash. For the essentials, of course, food, shelter, utilities, clothing, transportation, but also for the surprises that may come up. It's important to not only save the cash, but also to put it somewhere sticky. In addition to cash on hand or in an account separate from your daily checking account, it is important to make sure that other appropriate insurance plans are in place for the following categories. First, loss of income. Second, family needs. Third, large ticket replacements. And fourth, other cash requirements. First, losing income from being laid off or because business or projects have slowed down can be addressed with insurance or an unemployment scheme. In Finland, where I live, the unemployment scheme is quite straightforward, as the benefits are regulated and the payments are heavily subsidized and tax advantaged. Second, family needs are typically meant to replace the income needs of your own spouse or children, but may include parents, relatives, or other people for which you are a primary provider. Many countries have a national program in case of death, but optional life insurance is usually not very expensive for young people, and I would highly recommend it. In Finland, where I live, the national program doesn't come close to replacing the income level of the deceased, and I still haven't found term life insurance. So my wife and I have a $200,000 policy, which we will cancel once we are self-insured. Third, large ticket replacements include cars, white goods like washing machines, and home repairs. These are actually quite predictable and can be planned out beforehand using a sinking fund. Basically, this means setting aside the cash for a repair or replacement of some item which is worn over time through use. The last category of other cash requirements is just a catch-all. While absolutely a relevant part of an emergency fund, the goal should be to avoid using this category as much as possible. Once you notice a pattern that washing machines only last 3 to 4 years with 5 kids in the house, you can move those expenses into the large ticket replacement category. So those are the top 3 things to do already today to make sure you buy at the right time. Those 3 things are: first, don't put off purchasing index funds. Second, save consistently out of every paycheck. And third, save an emergency fund before investing. However, I did promise at the beginning of this video to share how I time my own stock purchases. Because my wife and I use a passive index fund strategy, we simply don't time our purchases at all. Every 5th of the month or the following banking day, if the 5th falls on a weekend or holiday, we buy 65% American, 20% European, and 15% Japanese index funds. That happens whether the market has just risen by 20% or dropped by 20%. And we don't care because we are getting the free lunch of dollar cost averaging. We really should cover that in more detail, but maybe that could be a topic for another video. So that's how I time my investments. How about you? I'd love to hear about your investment strategies in the comments. Have a topic you'd like me to go into more detail in a future video? Leave it in the comments. I will make more videos about saving, investing, and building your financial freedom in the future. So if you found this helpful, I'd appreciate if you hit that like button. If you haven't yet, remember to subscribe and hit the bell icon to be notified of future videos. If a friend of yours would benefit from this channel, please share. Thank you so much for watching, and see you next time.